Good morning and welcome to today's webinar hosted by Make UK and Inspired PLC. Today we're discussing our recently published report on energy procurement strategies. Before we begin, just a few housekeeping items to note. All of the attendees are in listening mode only, and only the panelists you see here have their video and audio available. If you want to engage with the panelists, you can do so by asking a question in the Q&A box at the bottom of your screen in the Zoom control bar. We're not using that chat function, so please do just pose your questions in the Q&A box. We will have time towards the end of the webinar to respond to the questions that are coming in, so feel free at any time to type your question into the box. Today's webinar is being recorded. All questions that are sent in will be saved as part of the webinar report. I'm now pleased to introduce you to your chair, Kate Fairhurst, Interim Head of Policy at Make UK. Kate.
Thank you, Carolee. Welcome everyone to this webinar to talk about the recent Make UK and Inspired PLC joint report on energy procurement. Hopefully you've all had a chance to glance and read the report so far, which explores what procurement strategies manufacturers have put in place since the energy crisis and whether these strategies are seen as vital to how manufacturers are operating. Joining me for the next hour to talk about the report and its findings are Verity Davidge, the Director of Policy and Public Affairs at Make UK. We have Jack Pearce, Senior Risk Manager at Inspired. We have Dan Hulme, Head of Sales at Inspired, and Laura McBrown, Managing Director at G&B. We'll hear from each of our speakers and then there'll be time for Q&A afterwards. So as Carolee said, please start thinking about your questions and popping them into the chat bar. So without further ado, I'm going to pass over to Verity now to kick things off and present the findings from the report. Verity.
Brilliant. Thank you, Kate. And I'm just going to share my screen now with you all. As Kate mentioned, hopefully you have glanced through the report, but fear not, if you haven't, I'm going to take you through a very kind of brief rundown of the findings, which I hope then will steer some of the discussion from our fantastic panelists and spur you all on to think of some great questions too. So as Kate mentioned, we really went out and asked companies about energy procurement within their businesses, essentially like how they are buying energy. And the reason why we wanted to sort of do a deep dive on this is that we know since the energy crisis, energy costs, energy bills, energy efficiency has really gone on the top of many manufacturers' agendas. But the energy crisis was actually now, 2.5 years ago. So while it was very much, the focal point for businesses then, we wanted to look a couple of years later about whether companies were still taking it seriously or whether they were becoming a little bit complacent. And if they were becoming complacent, was there a cost associated to this? So we're going to hear from Dan and Jack later all about the kind of the ins and outs of energy procurement strategies, what a successful strategy is and how it can benefit your business. But first, as mentioned, I'm going to take you on a quick tour of some of the findings. So we asked companies whether they actually have a good understanding of their energy bill, and perhaps it seems obvious that many of them say they're pretty confident in understanding their bill. In fact, 68% said they were very confident, and a further 32% said they were also somewhat confident. So just a small number of firms said they weren't really sure about what their energy bill actually looked or meant. But when it comes to your energy bill, and again, Dan and Jack will kind of take you through the importance of understanding the bill in more detail, it's important to note that there are kind of two types of costs within a company's energy bill, and these are commodity and non-commodity costs. So commodity costs are the charges that a business will pay based on what they've used, basically their consumption. So these are fairly easy for companies to understand. Now, non-commodity costs are also within an energy bill, and these are actually a lot more complex. These are charges added to a business's bill to cover the cost of delivering the energy onto that business. And these costs can also include charges such as government levies, and there are a fair few. And it's important to kind of just set that out from the start, because businesses really need to understand the differences in these costs, as their ability to reduce their energy bill, which is probably what many of you want to do, will really depend on which of those costs can and can't be decreased. So when it comes to commodity costs, businesses have more ability to actually influence their energy bill, and we'll be finding out a little bit more how later. While kind of variable and extremely volatile, the cost of energy can actually be managed. So the challenge for businesses is to understand when the best time to buy is and how far ahead they should buy. And we ask those questions within the survey. And I think, as Dan will share later, is what we found is when it comes to what you want to do and what you're doing, the two things are a little bit different. So, do companies have energy procurement strategies in their business? The good news is that the majority of firms actually do, but where it sits in the business tends to differ. So 81% of companies said they do have an energy procurement strategy, and this figure has likely grown since the beginning of the energy crisis. And we found this was particularly the case for firms with either 101 to kind of 250 employees, so that's sort of small to mid, and 251 to 500 employees. So very much on that sort of that mid company scale. Meanwhile, this figure actually dipped for smaller firms with less than 50 employees. They were the less likely to have a strategy, which is perhaps unsurprising, as they won't really have the resource and time to implement it. What does differ quite significantly is where that strategy sits within your businesses. So generally, procurement strategies tend to sit within either operations or finance, or shortly behind that with the MD or CEO. And again, it really depends on that company size. So smaller firms are more likely to sit within the MD or CEO, who probably has a lot of other things to also be thinking about. On the other hand, larger firms are more likely to have strategies that sit within perhaps facilities management or actually dedicated procurement functions. So they can really dedicate that time to getting that strategy right and executing it successfully. Now, of those companies with a strategy in place, almost 6 in 10 have one to help them obtain the best possible price. So this is why they have the strategy. They want to get the best price. And importantly, they want to beat the market average price. 2/5 of firms actually said that the key objectives of their procurement strategy is to have a long-term visibility of future costs. Again, quite a necessary mitigating exercise. And I think particularly this year, 2025, we know that the cost of business are going to raise significantly, not just thinking about energy, but all those employment-related costs that we've seen post the autumn budget coming in April this year. So mitigating those costs, having that long-term visibility is extremely important. When it comes to reviewing and revising strategies, we tend to find that manufacturers are reviewing their strategies every year, if not before, and most have undertaken a review since the 2022 energy crisis, slightly worrying those that have not yet perhaps reviewed it and may need to kind of rethink after this webinar. A key aspect of a successful strategy is really renewing and refreshing it. And like many other policies and strategies within manufacturing businesses, most are reviewing them every 12 months. So there's a very set kind of timeline in place. Some, around 13%, actually take a longer term approach and opt for 24 months, and a third are reviewing every 6 months. So there's quite kind of a varied array of kind of when they are reviewing and why. Now, reviewing every 6 months is likely a result of the energy crisis, and companies are really kind of keen to keep abreast of the market and assure they're not caught out by those volatile price changes that we've seen in recent years. But what's quite interesting, and perhaps we'll come into later, is how manufacturers are buying energy doesn't actually quite align with those ambitions that we saw previously around getting the best price. So if we look at the types of contracts companies are taking out, over half, so 55% of firms said they last bought a fixed priced, fixed term contract. However, this is not always the best means to secure the best price or indeed offer the most appropriate flexibility. So your fixed price and term contracts can offer you predictability, visibility, but equally, they probably don't give you the best outcome that you want. And again, we'll hear from the Inspired team about what they think is best for businesses in order to really cut your energy bills. Now, when it comes to working with suppliers and thinking of those contracts, manufacturers tend to contract with suppliers for 12 months, which again is quite relatively short term in the grand scheme of things. So 80% of respondents stated that they reviewed their supply contract within 6 months of the renewal date. Again, which could actually be going against their goal to obtain the best possible price and beat the market average. But let's sort of bring it back to why all this sort of matters, because businesses, as I mentioned, are facing huge cost increases this year, and energy costs still remain a significant part of those business costs. Manufacturers have increasingly told us in recent years that energy costs are now consuming a larger portion of their total business costs, and this is what this kind of slide really shows. In fact, over a quarter of companies say that their electricity costs are now between 11 to 25% of their total business costs, which is huge again when we compare that to the pre-energy crisis. And 19% say that gas costs are between 11 to 25% of their total business costs. So it's unsurprising that gas and in particular electricity costs are subsuming the greater amounts of total business costs than perhaps say other fuels. And this really aligns with Make UK's wider research, which has continued to show real concerns about increased energy costs. In fact, Make UK's executive survey that we ran a webinar on quite recently revealed that 70% of manufacturers saw energy costs as a risk to their business in the year ahead, and companies were continuing to identify ways in which they could mitigate those costs. So it's really on the minds of manufacturers that we need to get those energy bills down, and then looking for help and guidance of how to do so. And Inspired are here to give you all that help and guidance. My job, as always, is to campaign on your behalf when it comes to government. So we thought we'd ask you all, what are the best ways that government could actually help reduce your energy bills? Because 34% of manufacturers still say they're really concerned about the potential increases to energy costs in the next 12 months, and a further 52% are somewhat concerned. So there's a real concern hanging around them still that we don't quite know what will happen to energy. So what do they want to see happen? They gave a hit list of kind of 5 key asks, and I think about 4 out of the 5 we could probably push government on. One pretty questionable, but hey, we might go there in the end. The first is around kind of stronger incentives for on-site generation, and by this we mean also a lack of kind of disincentives for investing in on-site generation. One of the things we continue to hear from manufacturers, and I'm sure Laura will be picking this up later, is that when it comes to making energy improvements and energy efficiencies, it often comes at a price. In particular, it tends to add to your business rates bills. So even though government has offered some mild reliefs in this space recently, they're still not long enough to help companies make those investments. Companies also told us that they wanted an industrial energy price cap. Not sure we'll be getting this one. I imagine it would be quite costly. I think the closest thing that we've had to this in recent years has been the Energy Bill Relief Scheme, which we got on the back of the energy crisis. But again, because these measures are quite costly, that's a hard one to push for government. Perhaps more of the kind of one we could be looking at is around grid capacity and infrastructure expansion. So companies really want to see, increasing the capacity and flexibility of the grid is quite an urgent matter, and actually moving from kind of a first come, first served in that grid queue to a first ready, first served, and get people connected. And the other one we are really pushing, particularly for our SME members, and again, it'll be interesting to hear from Laura later about her experience, is for an industrial energy market regulator. Now, the non-domestic market is currently unregulated, and that means there's no real protection for businesses, particularly SMEs, who have been arguably burnt over the past few years due to a lack of understanding of the energy market. So we do feel there is a case for Ofgem and others to intervene a bit more strongly in the non-domestic market to protect those businesses. So there you have it, Kate, a very quick overview, some of those key findings, what companies want to do, what they are doing when it comes to their procurement strategies, and what they would like to see a little bit more from government in terms of support.
Brilliant. Thank you so much, Verity. You were bang on time as well. So now the pressure's on Jack Pearce, Senior Risk Manager at Inspired, to keep time as well. I'll hand over to you, Jack.
Thanks, Kate. Jack and I are going to tag team this section. So
Oh, great. Thank you, Dan.
I'll make a start. Hopefully my slides don't let me down. Can you see that, Kate?
Yep, we're good.
Sorry, yes, we can. Thank you, Dan.
No problem. So just wanted to start with a bit of a recap of some of the results from the survey that Verity's just run through. Some of the more poignant points that stuck out for us, more around the strategies that businesses have in place versus the goal that they're actually trying to achieve. And we actually felt there was a bit of a conflict in some of the answers that we got back from the survey. So as Verity's run through, 58% of businesses or respondents to the survey wanted to achieve best price, and that was defined by a price that's better than the market average. But 55% of businesses run a fixed price contract, and we'll come into why that's a bit of a conflict in the next section. But essentially, on a fixed price contract, we looked over the last 12 months at the market prices and figured out what the market average price was for any given day throughout that 12-month trading period, if you will. And effectively, it worked out that if you were to achieve better than market average price, you'd have a 0.27% chance of getting it right on a fixed price contract, because essentially you're going to market on one particular day and have one chance, one throw of the dice, one throw of the dartboard, so to speak, to achieve that price being better than the market average. And of course, it's always hard at that point in time because you've not got the beauty of hindsight. You can't look back and go, oh, I should have done it at this point, or I could have waited a bit longer, or maybe bought way further in advance. So buying on a fixed price contract is not going to achieve the best price purely from a market perspective, and we'll come on to a couple of other reasons why. But change that then and look at a flexible contract, and this doesn't necessarily mean that your prices change all the time, but a 45.2% chance of getting that right, in the sense of achieving better than market average price on a flexible contract. So massively improving your chances of achieving your goal. Whereas on a fixed price contract, if your goal is to achieve the best price, going on a fixed price contract is not the strategy for achieving that goal. Some of the more interesting points as well, 40% of respondents want long-term visibility of costs, but the total of 88% of businesses contract up to 2 years. So I guess we probably could have done with a bit more validity on what we define as long-term visibility. But there is liquidity in the market, as Jack will come on to in a bit, sometimes up to 5 years in advance. So for having long-term visibility of costs, being in a contract with a supplier for a longer period than 2 years would certainly improve that visibility, rather than just being on a 2-year contract, let's say, or a 1-year contract. And 80% review within 6 months. So that I think 2 of the answers were 3 and 6 months of renewal date. So again, Jack's going to come on to this from a market perspective, but just referring back to the majority being on fixed price contracts and then reviewing that within 6 months of renewal date. If the markets are inflated at that point, within 6 months of your renewal, and the markets don't come back down between that point that you review and renew, i.e. recontract, then you're over a barrel. You have no other choice other than to fix out for another 6 or 12 or 24 months. And that really isn't going to help, where instances occur, like the energy crisis, for example. Businesses were coming to us saying, look, we've been offered £1 a kilowatt on our renewal, and there's absolutely nothing we can do. We either fix that or take a rolling contract, which is even worse. So being a bit more proactive is definitely going to aid in not getting caught out, even if you do remain on a fixed price contract. So just a quick refresher, really. As Verity mentioned, there's commodity and non-commodity costs, and we've just provided a bit more of a breakdown here visually. So on the left-hand side, you've got an example electricity bill where 30, 40, maybe 50% of the overall cost is commodity. and that's determined by the price that's available in the market. The suppliers then have to invoice you for the transportation and distribution of that energy through, or electricity through the grid to your meter. They then apply all the taxes and levies that government impose on them, which they then need to recover through your invoicing. And there's a very small slither at the bottom left, which is the supplier's margin and the metering costs. So let's put ourselves in a position where we're going out to market today, for example, for our electricity or gas renewals, and we go out to 25 or 26 different suppliers in the UK market. All have the same visibility of the same commodity cost. So that bit remains unchanged regardless of who you tender with. The transportation distribution charges are the same for every supplier because it's the network that set those costs. Taxes and levies are the same for every supplier because it's the government that set those charges. The only bit then that in reality that you're able to negotiate on a fixed price contract is that tiny slither at the bottom, which is the supplier's margin, the margin. And on gas, it's a very similar position. So whilst you do have more influence on the commodity based on time or approach to market, because commodity is a bigger percentage of the delivered cost, on a fixed price contract renewal, again, you are purely just negotiating 2, 3, maybe 5% of your overall bill by going out to market on one particular day. In effect, what you're doing is ignoring the biggest percentage of your bill, the commodity, which you do have influence over based on timing or approach to market. So looking at alternative options to market and going down a flexible route. Now, this doesn't mean that, as I said before, prices change all of the time during your contract. You can still achieve 100% budget security through a flexibly bought contract. But what a flexible contract will give you access to is different markets. So it's still the commodity that you're purchasing, but you can buy in different granular blocks. Let's refer to it as blocks. So you can have quite low granularity in buying individual winters or summers. And in the UK market, although the weather forecast doesn't say this, the winter period starts 1st of October and runs all the way through to the end of March, and the summer starts 1st of April, runs all the way through to the end of September, apparently, or certainly in energy market terms anyway. So if you were buying a traditional fixed price contract for 12 months, you'd be buying a blend of summer and winter markets. And that blend would be determined by the amount of volume you consume during winter and summer. You can go then a bit more granular, so working backwards from the right-hand side of this page into quarters. So those seasons are then split into 2 quarters respectively, so you've got 4 quarters a year. You can then go even further left into more granularity and by individual months. And then even more granular again over on the left-hand side of the page where you're buying on the spot market. So you're kind of riding the wave here. We're not necessarily recommending everyone buys all of their energy use that way, because that wouldn't give you any security on price, but it could achieve the best possible price. So having more visibility or more access to different markets means you can be much more flexible, much more proactive, and it also has a massive impact on the risk premium. So just like any of your businesses, if you sell a product to a customer of yours, on a fixed cost basis, if there's a commodity or a raw material in there that can be quite volatile, you may have to add some fat into the price that you offer your customer to cover your own back with the fact that your commodity or your raw material could actually jump up or down in price quite a bit. And that's exactly the same with the energy suppliers in the UK. When you go out to market, ask them for a fixed price, they're looking at 12, 24, 36 months into the future and trying to guess what could happen. And then they're trying to give you a guaranteed cost for that period, which is extremely volatile and extremely risky. So there's a hell of a lot of premium that's added to prices in order to fix it for you. And we refer to that as the cost of convenience. So in the report, this is just a grab from the report. We have this bit of matrix on the screen. So the more simple, generally speaking, the higher the price, and particularly around risk premiums are concerned. So a fixed price renewal, as I've just said, suppliers are taking all of the risk. they've got to look at a very volatile market and guarantee a set cost for you over a set period. You're going to pay a big premium for that. If you move down the chart to something a bit more flexible, the suppliers aren't taking as much risk. You, as the buyer of the energy, is taking some of that risk then. As you move further over the complexity side to fully flexible contracts, there's next to no premium on the prices, because you're paying the screen prices that are available in the commodity market, but it is a lot more complex to manage. So that's one area. So we've covered supplier margins and negotiations there, and we've also covered risk premiums. So there's areas in which you can nip back your price, but ultimately the biggest impact you're going to have is on how you go to market and the commodity aspect. So when we're working with businesses, what we try and understand from their perspective is, what are they trying to achieve? And it was quite clear from the respondents and the results that I think there's a bit of misconception in having a strategy, what its purpose is set out to do and what it actually achieves. So on the top chart there, we've got budget certainty on the right hand side and achieving best price on the left hand side. And when you choose a fixed price, a traditional approach, we refer to it as a retail fixed price, because you're going through the retail market, you will achieve budget certainty at the point that you sign that contract, so providing the supplier locks in and agrees that price, and you're not trying to sign it on a very volatile day where sometimes they can come back and say it's not locked in, you need to refresh those quotes the next day. On a flexible contract, you can achieve budget certainty. You can also achieve best price, but you're not going to be able to do both in the same contract. And that there isn't a contract or an approach to market that achieves the best possible price and 100% budget certainty. So what we try and get businesses thinking about is where you sit on that sliding scale of budget certainty against best price. The sliding scale below is quite interesting. So on the right hand side, you've got really low risk. On the left-hand side, you've got really high risk. And this is where we're now trying to understand the appetite for risk of a business. And as you'll see, retail fixed is over on the high risk side. Most businesses probably think retail fixed contracts are actually really low risk, because once you sign it, you're fixed and your contracts are locked in and your numbers are secure. But from a price risk perspective, it's possibly the riskiest approach to buying energy, because you have one opportunity in a year. If you go out to market and make that decision, you've bought a year or 2 or 3 years worth of energy on one particular day. And if we just refresh our minds of what the market's done over the last 15, 16 years, from 2007 to 2020, the market was reasonably stable. So buying on a fixed price contract, fixed term contract, you're not really going to be exposed to too much change in price, maybe a doubling or a halving of price on renewal, but that's the worst case scenario. So the market in commodity market terms reached highs in the 2008 financial crisis of just below 10 pence a kilowatt, £100 a megawatt as it's traded. And then during the start of the pandemic and all of the initial lockdowns, where all of the demand came out of the market, prices for future contracts were below 3 pence a kilowatt, £30 a megawatt. From that 2020 low, we've then seen a steady increase through 2021 and early parts of 2022, where we saw the recovery of that demand once some of the lockdowns were releasing. We then saw the invasion of Ukraine from Russia in 2022, which then led to that real tall spike where prices were £730 a megawatt, 73 pence a kilowatt in normal terms for the commodity during the peak of that energy crisis, where gas flows into Central Europe were cut off and reduced significantly. Since then, prices have reduced, and we're now tailing to the right-hand side of that chart about double where the pre-pandemic market was. So over that 2007 to 2021 period, the market highs were about 10p, the market lows were about 3p, the market average was about 5p. As Jack will come on to very shortly, the market's now operating about double that level, so around 10p as the market average. So significantly more than it was pre-pandemic, but a lot more settled than it was during the price crisis. So Jack, over to you.
Great, thank you, Dan. Just to start off, I kind of want to start building on what Dan was just saying in terms of the cost of getting it wrong. So if you go on to the next slide, please, Dan. The first thing I wanted to talk about is the UK electricity mix and the picture of what's changed over the last couple of years. So as you can see from the graph on the left, we've seen that gas has been an incredibly important driver in the UK energy market, but it has been slowly decreasing over the years. But to counter that, we've seen a growth in renewables. And so far through January this year, we've seen exactly the same thing, that it really is renewables as a whole being really, really important to what's going on in the market. This reliance on renewables has created some massive volatility, especially in the short term. And just to kind of put it in terms of what was discussed earlier, with 80% of manufacturers reviewing within 6 months of renewal, what you might have what you might have is a period of, say, really low wind, for example, which in the short term might push prices higher for a couple of weeks, maybe a month, which if you're looking at a fixed contract, if you then pick it, if that that 1 month of 12, it's going to really look or really be priced out, and then the closer you get to delivery, the more wind and other renewables will be really important to what's going on in the market, and then the pricing of that contract. And to show an example of that, if you could go next slide, please, Dan, is what we've seen in January. So the first point of what I want to talk about is wind so far through January and February has been really low, much lower than seasonal normal. Just to give an example, as you can see from the top graph on the right for front season, so that's delivery from this April, we've seen prices increase quite drastically. We've gone from where we were at the start of January, kind of between 8 and 9p, to now, as of start this week, we're pricing above 10p for this front season, which that's a 20-25% increase in the matter of about 4 weeks, which, when looking at a fixed price contract, obviously that's quite a large increase. But on a flexible, you have the opportunity to lock just small percentages through that rise, rather than trying to pick just one day. But there's a lot of other drivers in the market at the moment. So one of the biggest things that we've seen supporting this rise also is what's been going on in the carbon market, for example. Again, growing on the gas being a really important driver. Over the last couple of weeks, we've seen that the UK have announced that they want to move over to the EU scheme. So we used to be part of the EU carbon scheme, but a couple of years ago we moved away from it. But the EU scheme is really high priced compared to the UK, which really drives that need for renewables, and PPAs often get discussed. But we've seen a 50% increase in price over the last 3 weeks, which has had a massive impact again on what's going on with the UK electricity market. We have seen also some other stuff with French nuclear. We've seen some restrictions in the short term. We're hoping that will get better during the summer, but for now it's still quite a important driver. And then kind of the other biggest thing that is pushing the market up at the moment that I'm going to build upon when I come to gas is what's going on with our storage. We are really quite low for this time of the year as a country. We're only sat at 30%, with still what is normally the coldest part of winter being end of February, March time. And it's a little bit of a risk at the moment, which also then means that during this summer, without Russian gas that we've had in previous years, and rise in demand in Asia, there is a risk this summer that we might not fill our storage enough for next winter, which just means the prices then for next winter and the summer afterwards, if you're looking at an October start fixed contract, the prices are rising, and there's a risk that they may not come back down. at the moment. However, it's not all doom and gloom, and there are some bearish factors, some downward drivers, especially in Norway, for example. They've had some really strong hydro. La Nina has really provided some support in terms of what's going on with the currents. And the rivers, there's been lots of rain. It's been really good for the hydro. And then a couple of other things. So UK nuclear power is likely to remain really strong, sorry. And there's also likely to be a ramp up of coal-fired generation in Germany and Poland, which could just support the drop in gas that we're now not getting from Ukraine and Russia, that historically have always been really strong supplies to the UK. And then, as I mentioned, hopefully French nuclear should be quite strong through the summer, which means that it might be a bit of a bearish drop to prices. But one of the things to put in context of what Dan was talking about, and the reason why we recommend the longer term contracts, not just flexible, is what's going on with prices at the moment. So the market's in a state of backwardation, which effectively means that the cheaper... Sorry, you want to say something, Dan?
No.
The further out you look, the cheaper the market is. So at the moment, as was saw on Dan's screen, that the front season, so this summer and this winter, is currently being priced at just above 100 or 10 pence a kilowatt hour, £100 a megawatt hour. But if you look for the further out years, especially summer +2 and winter +2, looking 3 years out, and year 4 is then even lower again, we're still able to buy that market at high 6s for the summer, high 7s for the winter, and it's a 20% discount on what we can buy on the front, which is a really good opportunity for manufacturers that at least have a strong view of their consumption, to be buying those further years, which you can do on fixed contracts.
Yeah.
But there's often a lot of risk premiums put in place because of that uncertainty that far out. Whereas with a flexible contract, you don't have those risk premiums, but you can still buy those prices, and it works well for that balance, as Dan was saying, around the budget certainty and the best price. It works well. But then the last thing I want to touch on with electricity is from what Verity was saying in terms of how we're trying to work with the UK government at the moment to try and generally improve the situation in overall energy prices. So at the moment, you can see from this graph that just a couple of big countries that we get a lot of imports from Europe, and at the moment, UK is incredibly high priced compared to Europe. You can see about 25% discount for France and Belgium, for example, and then Norway is much lower than what we pay at the moment. We have the ability to obviously import this, but the way our kind of generation and our economy is set up at the moment is very expensive in the UK, and that's one of the things that Make UK and Inspired are working together with to try and support and bring us more in line with other countries around Europe, because we are a bit of a standout at the moment. And then just quickly, just want to touch on gas. I've kind of already mentioned that gas is obviously quite a big driver and that storage is really low at the moment. And we've also seen, so Ukraine is actually one of the biggest storage hubs in the whole of Europe. And they historically have actually stored close to around about 40% of the entirety of European gas. They had a tendency to buy it during the summer and then sell it to the rest of Europe during the winter. But at the moment, it's really low, and it's not looking to increase while this war is still going. I kind of already mentioned wind, but we've also seen, so another bullish factor is, so to make up that drop in storage and drop in supply, we're having to buy a lot more liquid natural gas. So that's gas on tankers, primarily from places like Qatar, America, and we've recently started buying from Australia again, which we haven't for a few years, which is providing a bit of support. But again, yeah, so some reverse factors we are now getting that LNG. It's we've been starting to buy it a lot more over the last couple of months. It's starting to come through, which is really, really good. Hopefully it will support a bit of prices in the short term. But there is some talks around obviously the peace deal that Trump is trying to bring in, working with Ukraine and Russia, that we could see a possible return some flows through Russia to Europe. It's not certain yet. Obviously, there's nothing really been announced or said, but there is some hope that prices could lower, but nothing to be seen as of right now. And then, obviously, as I already said, the coal fire generation in Germany and Poland is hopefully going to bring a bit of support to Europe as a whole, being the primary hubs. And then just the last slide for me, just wanted to show that the gas is exactly the same as electricity in terms of buying those future years. The longer-term contracts at the moment are really, really good. And those further out years, we really, really want to recommend making the most of those periods. And those long-term contracts are the best way to make the most of the backwardation in the market at the moment. But yeah, that's it for me. So thank you, Dan.
Thanks, Jack. So we've covered kind of our view on the respondents to the survey, where we don't feel that in some cases the goal of the businesses that were responding is aligned with the strategy that they've set up, or the strategy is not allowing them to achieve their goal per se. Jack's kind of covered the state of the market as it is at the moment, what opportunities exist for better purchasing, and now we're just going to have a quick look at a couple of different options that certainly Inspired offer to make UK members. Some of the flexible options that are available can be prohibited to smaller users purely because they don't have enough volume to warrant purchasing and in multiple tranches in the market. So one thing that Inspired set up many years ago was what we refer to as collectives, but essentially they're a basket or a consortium. And it's just an aggregation of lots of businesses' volume on a predefined strategy that allows then access for the greater volume in that basket to the wholesale market. So it means these small businesses that wouldn't have enough volume in their own right, they can now get access to flexible contracts. And as I keep reiterating, flexible doesn't mean that your prices will change. So on this example, think of them a bit like a pension fund. So there's lots of different businesses within this fund. And this risk profile of this fund is low risk, high certainty. So on the left-hand side, we've got wholesale prices, and these aren't true as of today. These are just indicative for the purpose of explaining how these different strategies work. And we've got time across the bottom. One option is to take a one-time view in the market and fix out for 3 years in this example, which means that you've achieved a price on the day that you sign and you know what it is for that set period of time. What it also means is that you've missed all of this opportunity. Hopefully you can see my mouse wiggling here. All of this opportunity here where the market was below that number that you fixed at. All right, you've avoided these couple of peaks here, but the average of the market was well below the price that you fixed. Another alternative is to buy flexibly, but in advance of when you need to consume that energy. This applies for electricity and gas, and on electricity you can also buy renewable 100% renewable power through these strategies. So if we picture today being this thick black line on the left-hand axis, the dotted blue line being your future renewal date. So let's, for example, say we've got a 7-month trading window here, and your contract aligns with the start of winter, 1st of October. So anyone who's got a renewal on the end of September this year, this is, I guess, relevant to you. Over that trading period, the market moves up and down, and there's multiple opportunities, 7 months worth of opportunities to decide when to buy the energy. Now, as long as all of that energy is bought before you come to consume it for that period, so October through to the following September, your price will remain fixed for that supply period. So you've achieved budget certainty. We're now trying to focus on how we get the best price for that certainty. And on this strategy, just illustratively, we've purchased in tranches. So on this particular trade here, we bought 15% of that forward consumption requirement, another 15 to take us up to 30% covered, another 15, another 15, 25, and then a final 15. And what that meant is by the point that that contract goes live, 100% of that future consumption is bought, but the price that's paid for that supply period is a weighted average of those trades that have been made over that period. So you still achieve 12 months of fixed costs, but you've not had to take the risk of going out to market on one particular day and buying it all and hoping to God it's the right day. You've spread the risk by spreading the purchases over that time period. That can then be repeated for delivery year 2, so October next year, October 27, and even further into the future, October 28. The same applies for April renewals as it does for October. I was just explaining that there's a 7-month trading window there rather than a couple of weeks left for April. So that's one strategy option that's low risk and high certainty. Again, what this will achieve is fixed costs throughout each supply period of 12 months at a time. And come the point of your contract starting, you know what your numbers are. So they're good for certainty, good for security, and low risk because you're not having to buy all on one particular day.
Dan, can I just interrupt very quickly?
Yeah,
sorry, I'm just very conscious of time, and we've got
Yeah.
Laura next, so I want to leave enough time for her.
No
if
problem.
you could finish up in the next couple of minutes, that'd be great. Thank you.
So using the same methodology again, this is on a medium risk, but more focused on optimizing price now on the strategy. Again, one option is to fix out. Alternative is you've got a delivery period to buy for. So let's say October again this year. Between now and October, you want to start making purchasing decisions. On this strategy, it's a bit higher risk, so medium risk profile. And on this strategy, we'd buy some of the energy before you need to use it. So you'd have certainty on the percentage of energy that's been bought prior to the contract starting. So in this example, 85% of the future requirement's been bought prior to the contract starting, and then the remaining 15% has been bought whilst the contract's running. So for this example, 85% certainty of cost prior to contract starting, and then the remaining amount of energy was bought as the contract was running. And that meant that, for this example here, on the previous strategy, all of that energy would have had to been bought in that trading window, whereas actually just after the start of that contract, the market further reduced. And anyone on the previous strategy would have missed out on this dip here, whereas this strategy allows you to take value whilst the contract's running of any market movement. Same principle applies again, trading further out into the future. So being able to capture some of that backwardation that Jack explained before, where the markets are cheaper the further out you buy at the moment. So you could get some certainty and take some advantage of that low cost whilst it presents itself. And then some of the remainder of your volume could be bought whilst the contract's running. So those just a couple of different options that are available through those collective strategies that are operated by Inspired. I'll whiz past these because I'm conscious of time. Laura, over to you.
Morning, everybody. Thank you. For those of you who don't know me, I'm Laura McBrown. I'm Managing Director of G&B Electronics. We're a contract manufacturer of electronic products, so circuit boards. So we have lots of production lines, lots of ovens, reflow ovens, wave soldering ovens. And we sort of fell into the category of companies who would go out and fix their energy for 3 years. It wasn't a job that anybody wanted, and so therefore it ended up that whoever ended up with that job would fix for 3 years in order to not have to repeat the experience on an ongoing basis. Helped us with budgeting, all that kind of stuff. So we're fortunate that we'd signed up for 3 years just before the energy crisis, but we did recognise that we were going to be heading towards a problem. So we needed to do something to sort of mitigate those risks. And I know there's lots of manufacturers who were not so lucky. And I think, Verity, going back to your point, you know, some help from Ofgem for people that were in that situation would be most welcome, I'm sure. So we came across Inspired at that point, met up with Dan. Dan and his team came out and did a review of our facility to help us just sort of understand, you know, what our challenges were. I think, like a lot of SMEs, we hadn't considered having energy strategy previously. We're also in a rented building, so that gives us limitations with what it is that we can do, and the challenges around trying to talk to our landlords about solar panels and what we can do in that space, which I'm sure many others have come across. We also had the challenge around looking at whether the building that we've got that's a little bit older, whether the roof was suitable for solar panels and what work would need to be done to that prior to fitting solar panels. So again, in terms of what the government can do to help with that, you know, in terms of new roofs that we don't really need but might have to pay for, would be most welcome. So we did all sorts of stuff, as I imagine lots of contract manufacturers did. Inspire did a review of us to help us understand how we used our energy. And what we identified is that, you know, with a lot of ovens, we use a lot of energy in the morning. So we looked at doing a compressed week and running our factory 4 days a week rather than 5 in order to reduce our energy usage even. We also looked at things around just the small little wins. So, you know, changing our hand dryers to more energy efficient hand dryers, LED lighting, looking at making sure we're using our air conditioning effectively. We changed our compressor to a compressor that sort of monitors the usage of the machines that we're running, so that it monitors its own energy and is more efficient in terms of its running costs. We also then use the heat that compressor generates, and we can use that to partially heat one of our workshops in the winter. So it's just trying to look at all of those things. But we did embrace what Inspired offered. We were nervous about it in terms of, you know, hedging anything is not our bag, and understanding that market. So to be able to sort of work with them, Dan and his team were very patient with us. We ummed and ahed a lot about the risk of going into something where we don't have those fixed costs that we're used to. But we also felt that the market was, the cost of energy was reducing, and we didn't want to, you know, put ourselves in a position where we weren't competitive with our energy costs either. So we signed up, and I think we've been with you guys for just over a year now, but at the end of our first year, we've made a 7% saving compared to what we thought we were going to spend. So we're happy with what we've done. There's more that we can do in terms of understanding how to control our energy usage and how we run our whole facility more efficiently moving forward, but not have to worry about you know, the actual purchase of the energy is certainly one way off of our mind. And so, yeah, can thoroughly recommend having a chat with Dan and his team.
Thanks, Laura.
Sorry, Dan, you carry on.
Yeah, no problem. So Laura mentioned a review, and it's something that we offer here at Inspired to all Make UK members free of charge. It's called the Energy and Carbon Health Check. And essentially, me and the team look through, if someone scans the QR code, fills in their details, we get in touch and we have a chat. During that conversation, we'll request the information we need to complete that assessment. All of this is free of charge. And of course, if any NDAs are required, etc., then happy to complete those. But essentially, the output is a review of your consumption patterns to identify any out-of-hours consumption, any consumption patterns that don't correlate with on-site production. We look at overall consumption to see if we feel it's high, for the activities that you're conducting on site. We review your procurement strategy to identify if there could have been savings through that contract and what your options would be upon the renewal. We also look at any tax exemptions that you may be eligible for through energy schemes such as climate change agreements or CCL exemptions or the energy intensive industry scheme. And finally, we have a quick check on your public facing view of the business to see what your green credentials look like and what that may be viewed as from a prospective customer of yours, and give you some pointers and direction as to how you could improve that. So I'd welcome anyone to take that opportunity. It's free of charge. There's no obligation off the back of it. Andrea at Honall Precision left us a very kind piece of feedback on the piece of analysis that we did for Honall Precision, another member. Well, it's a free of charge service. It'll give you some pointers. I'm pretty certain we'll always find you something that will save you some money, or at least create some thought. So please do take us up on that offer.
I think from our perspective, one of the other things that was a big tick in the box is that we can now say that all of our energy comes from renewable sources as well, and that was important to us and our clients.
Yeah, absolutely.
Brilliant. Thank you so much, both of you. And hopefully everyone on the call got a lot out of that. I know that I did. We've got a massive 4 minutes left for a couple of questions. So I'm going to fire one at you, Dan, if that's okay. And we're aiming for 30 to 60-second answers, so then I can fire one at Laura. Other than the services you've just laid out and the advice that Inspired offers, what do you think is the one thing that manufacturers can do today to lower their energy burdens?
Have a look at their consumption patterns. So for electricity meters, typically a manufacturing business will have a half hourly meter, which is read every 30 meters. You can download that information from your energy supplier's portal most of the time, and that'll give you 48 meter reads a day, every half an hour, 24-hour periods. You can map out that data or conditionally format it. We're happy to show you how to do it. It's dead easy to do. But what it'll do is identify any out of hours consumption, any peaks in consumption, and whether that correlates then with production activities on site. The next step from there would probably be to look at some kind of sub-metering devices or technology to understand where the energy is being used within the site and potentially left on. And that would also give a bit more granularity as to cost of production for certain production activities or lines of manufacturing. But yeah, understanding your consumption data is huge, because every kilowatt that's wasted is a kilowatt that didn't need to be used. It's the most expensive one.
Great. Thank you so much, Dan. Laura, what do you think is the one thing that government could do to help your business cut its energy bills?
Oh, that's a tricky one. I agree with the 5 findings from Verity's report. I think it probably is a combination of stuff in terms of better regulation and support for businesses in general, as well as looking to try and sort of match the European prices that our neighbours are getting. So I think there's, I think there's probably a lot of little 1% that the government could just tweak a little bit just to make things a bit easier for us.
Great. Thank you so much, Laura. Dan, Jack, are there any final thoughts from you for the last minute that we have?
I'll let Jack go, but I can see he's still on mute, so I'm suggesting...
Nothing from me.
Okay. No, just a final point from me, really. You may have noticed on the screen there that we're holding some sector forums in spring this year, in April. These sector forums aren't just focused on the cost of energy, but consumption and carbon emissions and how you identify that waste or how you identify opportunities to reduce it. They are being hosted at some of our client sites, which just so happen to be Make UK members. So on the 3rd of April in Redditch, we're being hosted by Thorlux Lighting. They're really great days, quite a small group of people, maybe 20, 30 people, so we can be really interactive and spend a lot of time getting people networking with one another. And then on the 10th of April, we're up in Sheffield at Special Melted Products, both of which sites will be offering a bit of a factory tour afterwards and a bit of an explainer as to what they do around their key energy and sustainability challenges. Again, they're free of charge to attend. They are very informative sessions for anyone who attended our road shows in June last year or November 23. You'll have seen that, you know, the level of information that we give out on the day. So I just recommend anyone, if you're within a couple of hours travel of either Redditch or Sheffield, I definitely recommend you come and see us on that day.
Brilliant. Thanks so much, Dan. And I know that you and Jack are very happy to receive questions from those on the call if any occur once all the information is percolated over the course of the afternoon. Thank you everyone for joining. It's been great to have you here. Thank you so much to all of our panelists, and I will draw the webinar to a close now. Thank you all.
Thanks, Katie.